Hey guys, it's Nicholas here, and in this video, we're going to do a spotlight session on Euro Aussie dollar. So if you haven't watched any of our spotlight sessions before, because there haven't been any for quite a while now, it's basically where I pick one particular market and break down how I'd be approaching it, like what my analysis is, or if I've already opened trades on it, then I talk you through where I open my trades, why I opened them, and how I manage the position. Now we used to have these videos a lot more frequently on this channel, and I think it was a bit of a favorite amongst the people that watch our videos. But as we started to move our analysis more into our members area and in our market selection videos, which by the way, market selection service is free, linked in the description box down below, and I'll be referring to that quite a few times in this video. But as we started to do that, then all of our analysis shifted over there and we didn't have analysis on the YouTube channel anymore. But I want to change that, and that's starting with this video. This is going to be the first of many more spotlight sessions that we'll do. And in fact, as we're starting to test out live streaming trading in our members area, where our members can follow along as I'm trading live throughout the day, we may even do some live sessions on the YouTube channel of these sort of breakdowns. So if you want to see more videos like this, then already hit that thumbs up button. Let me know in the comment section down below. And also, before we get started, I have to point out that this analysis, this method of trading is based on how we trade, which is the Duomo method. So if you're not learning the Duomo method and you're not interested in learning the Duomo method, then obviously this video is not going to be very useful for you. All of the different aspects of how we trade are very interdependent and interrelated. So it's not like you can just pick out one part and use that in your system. I mean, maybe you can, but it tends to be that you need the whole thing to be able to trade in this way, because they all play a role in the overall approach. Now you're going to pick up some of that from this video, but otherwise I would recommend checking out our free course, Introduction to Trading the Duomo Method. It's linked in the description box down below as well. So there you go, there's two things you can sign up for: the free market selection service and the free intro course. So you're probably wondering, why are we picking Euro Aussie dollar for the first spotlight session? It's a bit of a random pair. And in fact, it's not one that I usually even follow or trade. I don't tend to look at Euro Aussie dollar. The reason I've picked this, there's a couple of reasons. The first reason is that last week our market selection was very much focused on this pair. Was it maybe the week before? I'm losing track of time now. So a lot of you were following along with us, and we anticipated the trade entries like a couple of days in advance. So it's definitely not a case of cherry picking something in hindsight. Also on our Instagram story, if you're not following on Instagram, it's at Duomo Initiative. I posted at the time of my trade entry at 5:45 in the morning UK time, and then I posted updates of how the trade was going, where we did the stop loss dance and so on, and then spoke about how I was approaching the exit during our Facebook Live of that same day. So I chose this one partly because you all got the chance to follow along live, to show it wasn't a cherry pick after the fact and I'm not doing hindsight trading, it was live as well. And the second reason is that for one situation, this market contains so many different lessons, so many aspects that I can explain to you that might improve your trading if you're trading using the Duomo method. So it actually contains maybe a few of the lessons that we've mentioned in some of our last few videos that we released on YouTube. Definitely about how we approach economic news, definitely about negative filters and things like that. So I think this is a really useful case study to help you understand some of these concepts in a practical real life example. And that's what these things are best for. It's not just to show off how the market moved around our levels. It's to help you learn when to use things in a real life setting. So I think I've nassed on too much. Let's just get straight into the chart here. And we can start off by looking at the daily chart. This is where mainly things started off. Now, when we first started looking at this, this market, I believe it was somewhere around here. So obviously now we're looking in hindsight. So we've had all of this stuff happen afterwards where we've had the bullish move. So what you're going to see here is that we've got some levels that we were expecting a bullish move from, and that's what we ended up getting. So if you can just ignore all of this for now, you'll know what we're getting at. Sorry to spoil the ending of the film, but it ends up going quite well, although there are some tricky moments, and that's what we've got to pay attention to. So the first thing we do when we approach a market is we're looking at the structure. And in this case, we had a very, very nice, easy to analyze structure. We had almost like the Goldilocks waves, what we like to call them, just right. It's not too small, not too big. I mean, they may be slightly on the larger size, but I think that's just because that's the type of waves that they are that we've got here. So you can see that we're obviously in uptrend as we get to that point. We've had higher highs, higher lows, and we were first of all mapping in this trend line. Now, I know a lot of people don't like trend lines and they complain about them. It seems to be the new thing. And in most cases, I agree. But the thing about trend lines, and the thing about most tools, in fact, is that it depends on how you use them. So trend lines, I think, are massively underrated. Like everyone uses, like not everyone, but a lot of approach to trading use trend lines. It's one of the most basic things that everyone learns. But there's a difference in using something correctly and not using it correctly. Like I always use the example of a sieve or a colander. You know what you use to sort of drain out your pasta. So if you try and use a sieve for holding a drink, then it's going to be pretty useless, isn't it? Like it doesn't do its job. It's not holding the drink. But if you use a sieve to actually filter the solid objects from the liquid, then it does its job quite well. And that's the same with a lot of tools. There are lots of tools that are absolutely useless, even more indicators that are absolutely useless because most of them are. But there are some tools that if you test and find the optimal way of using them, you will actually find the right way to use them. And with trend lines, I know they get a lot of hate these days, but for anyone that's learning our method of trading, anyone that follows our market selection, which is free in the description box, these people will know that they do really work because we can anticipate ahead of time. As long as you're looking for type 1 or type 2 closes, they do work, and as long as they're mapped correctly. So because we were having these higher lows, we had this trend line mapped in. Now, if we just zoom out a bit, you can see where it starts over here. So 2 touching points is unconfirmed for us. Unconfirmed, if it's part of a double confirmation, will be a probe trade. And we have a video about probe trades coming out, I think it's next week, so stay tuned for that one. And the 3rd touching point here makes this a confirmed level. So we have 1, 2, 3, and this is confirmed now, and we can trade it based on a type 1 or type 2 close as long as the overall conditions allow us to actually open a trade, and that relies on a double confirmation. So that's an important thing to note always with the Duomo method, is that you never just take one thing in isolation. You never just think, oh yeah, I know how to use trend lines, I now know how to trade using this approach, because it matters as well about how we get the close, how the price approaches at the close, whether you get a double confirmation, the context of the market in terms of the structure, and so on and so on. So there's a few other things to consider. But if we're looking for a double confirmation, now the next thing we want to look at is what's happening in this move down. In this case, we had very strange structure in this move down. You can see that we reached the peak of this wave, and you might see this as a very direct move down. But if you look closer at what's happening, we do actually have some medium-term waves in between, very, very slightly. And this is a really messy situation. You know, a lot of people wouldn't pick up this Fibonacci range here, but it actually works. So we've got the A point, we've got the B point, and we know we always want to confirm the C point. And you can see over here, we have the C point confirmed at the 50% level. But here we have quite a big gap up to that level. Now, with the Duomo method, we have an approach when we have a gap in the market. We have a way of approaching this consistently. Now, it's not that this is the way it works every way, but with a lot of the ways that we approach the markets, it's based on statistics. In other words, we've tested the different ways of approaching certain things and gone with the one that's most likely to bring you success. So when there's a gap in the market, we assume that the gap, like the opening price, where the gap opens to, is also where the closing price of the previous candle was. So in other words, in this situation, it's almost as if the bullish candle closed up here. It's like we amalgamate the candles, we bring them together. Now, as I said, sometimes it will be that actually this point down here was the close of the candle, and that's how you should treat it, that's the close. But statistically, you're more likely to find that you can treat it like this was the close up here. So in that case, it closed as a type 2. Well, actually, it closed at highs on that 50% level. So it's kind of like a type 1. If we were going to be trading a level and it closes at highs, we wouldn't want to trade it. But for confirming the Fibonacci range, it's fine. So this range is confirmed. And at this point, we start to be interested in the extension levels. So you can see down here, we actually get that type 1 interaction at the 127.2 down here, and we get some sort of reaction. We wouldn't be trading this because it was a single confirmation, unless you count this very, very tiny swing high, which I don't think we would. But what this did was show us that it's likely that this is the correct significant level. So next, we're looking at this 161.8 down here. And you can see, because it's so close to where the trend line is, there's an opportunity to maybe get a double confirmation there. And that's precisely what ended up happening. Now, just before we get onto that, now let's move up to the weekly chart and I'll explain the situation there. It was very, very similar. So we can see that we've also got a strong trend line, strong and dependable one with the 3 touching points there. And rather than it being a Fibonacci range that we're looking for, we're looking at this swing low. Okay, a break of that means that we're potentially going to be in downtrend or at least weakness in the structure. So that was another interesting point, and this bearish candle here didn't exist at the time. That's what we're going to be trading. So going back to the daily chart, you can see also we've mapped in this swing low down here. And in my market selection video, I was saying that basically if this momentum, because there was quite a lot of momentum around here, if this momentum continues, then we would maybe fail around this area and instead be interested in this point down here where we've got a very strong swing low. And it could be that this is building to a double confirmation. Now, obviously, if it's going to build to a double confirmation, it means that we wouldn't be trading it until, like Thursday or something, or Friday maybe, depending on when it happens. But we can still get those intraday bounces from this area. And then if it does break through there, we'd obviously be then looking at this swing low, but that's not for a long time. It's not going to happen today. Also, when we were around here, already this candle, I'm just going to zoom in so you can see this properly now. When we were around, it was on this day, like I think it was even the open of this day, I was already saying, or maybe the next one along, I was already saying that I'm prepared to start looking for long entries already there and potentially take some relatively smaller losses on the way to maybe getting a bigger entry down here if it pushed through. And the reason that I was interested in taking that is because this trend line is more than just a trend line, it's what we call our baseline trend line, which means that it's also the outline of the market, and sometimes you don't even need an interaction to have the price be repelled from it to get that reversal. So already from here, the sort of lack of momentum that was happening, like where the momentum ran out, was a sign that maybe it's already reacting to that trend line. I'd rather not miss out on anything, so I was prepared to either open a small trade or, depending on the setup, maybe even a probe trade. So if you don't know what probe trades are, don't worry, we're going to be talking about that in one of the very next videos on this channel. But keep in mind that because we hadn't quite reached that baseline, there was some uncertainty there, and therefore it may have been a probe trade. When you watch that video on probe trades, you'll come back to this one and you'll be like, oh, no, I get it. Okay, so a couple of days move on, and we can see that at this point now, we get a type 1 close at the 161.8 and a type 2 close at that trend line. That's a daily double confirmation. Now, I didn't actually pick up the entry based on the daily chart, but there are people that I've seen on our forum who did pick it up. If you're going to be opening a trade based on that, there are 2 different ways that you can approach this. So again, you've got to forget what happened with this bullish candle onwards, because that was the next day. If you're going to go long at the close of this bearish candle, you can either base your stop loss on the trend line or base your stop loss on the structure. The reason is that both of these aspects that we're looking at, whether it's the trend line or the Fibonacci range, you're expecting some sort of reversal to happen there. So you're expecting a bullish move. Now, we want to look for the earliest indication in terms of exiting at a loss. We want to look for the earliest indication that we're wrong, okay? Likewise, when we're looking at the trade management in a positive sense, if the price starts moving in our favor, we're looking for the earliest indications that things are right. So if you're going long and you're expecting a bullish move, then you want to start seeing signs that the bullish move is happening. So you want to base your analysis around figuring out whether it is or isn't. You're trying to answer questions with your analysis. So with this one, if we're having our stop loss, we're basing that on the fact that the price may move against us to be in loss. We want to find the earliest indication that is a continuation of a bearish trend, because you've got a bullish trend on these bigger waves, but you've got a bearish trend from here onwards, okay? So we want the earliest indication that this is taking over rather than this taking over. Got it? There are two ways you can do that. You can either base it on the trend line, in which case you're going to need two types of stop losses here. You're going to need what we call a soft stop loss, which is that if the price closes through that trend line, or in this case, actually, because we've got the 161.8, it would be also closing through that because it's a double confirmation. You want to take into account both of them. So if the price closes through there, not pushes through, but closes through, you would exit, which is why it's called a soft stop, because it can fluctuate around and not get closed. But the moment that that candle closes, you're out of the trade. Okay, so it's a soft stop loss. Then the second stop loss you need is your hard stop loss. Your hard stop loss is like your fail safe. If everything goes wrong, you have a get out no matter what. So let's say disaster happens and the price starts plummeting, you're not waiting for the close of that candle, which could be anywhere. You've got a hard stop, which is going to take you out of the trade. So your hard stop loss should always be placed in a place on the chart where either it's no longer viable being in that trade, or beyond that point, you think there's very little chance of it pushing back up to close above your soft stop. So it's a point where, you know, your soft stops are going to get triggered anyway. It's best to just be out of the trade. So that's if you're basing it on what we call setup. You see, with our trades, there are three things we're looking at all the time. And if you're learning with us, you're probably shouting these out already at your screen. We're looking at setup, structure, excuse my writing, and what we call the path of least resistance. Path of least resistance. So this would be exiting based on the setup if you're basing your stop loss around here. If you're basing it on structure, your stop loss is going to be here. Again, you're going to need a soft stop where the swing low is, and a hard stop just below. I'd probably place them below those wicks where I think, you know, it's pushed too far, it's not going to come back up. So it would be up to you. Now, the biggest consideration here would be the fact that if you're going to be basing it on structure, then you're probably going to have quite a bad risk reward. Here's your risk, and your reward is going to be, whenever we have the 161.8, we usually use re-entering the range. So this point here is re-entering that Fibonacci range. So that's going to be the return. So that's your risk, that's your return. That's if you're basing it on structure. So let's actually see what that ends up being. Whenever you're calculating your risk, you always calculate it to the hard stop, not the soft stop. So here we've got about 150 pips, and so the return is about 260 pips or so. So a bit less than a 2-to-1. I think it's viable, but what I tend to find is that more people get a little bit greedy and they want their risk reward on the entry to be better, and they will move their stop loss up to the setup. Now, when we're looking at risk reward, this is something that we do a little bit differently with the Duomo method that is not the sort of standard practice for trading. But our TMP, as our trade move potential, it's not a target. So when the price gets there, it doesn't necessarily mean that we're exiting. This is the first realistic obstacle for the price if the price moves in our favor. So we take that as being the return and have this the risk, because then we've got what's at risk in a worst case scenario and what our return is in a worst case scenario if the price moves into profit, where that first obstacle is likely to be that we're going to exit. Now, a video or two ago, I spoke about having your next decision point. If you're trading based on the Duomo method, your decision points should be here. The risk is decision point 1, and that's going to be by your stop loss. And your other decision point, if it moves in profit, should be your TMP. If you're going to make a decision sooner than it reaching your TMP, then your TMP should be down here or something then. It should be where your decision would be made. We don't always have to make the decision there. Sometimes something can completely change. The price hasn't done what we expect and we can exit sooner. But if you want to use that approach of more of a laid back set and forget style approach, like making decisions every now and then and not having some anxious reactionary trading style, then that's where you need to be placing your decision points. Okay, so some people would have entered here, some would have their stop loss here, and you can see the next day would have got triggered. Some people have their stop loss here and they would have been fine, and just today they would have been reaching TMP. For me, I didn't enter based on the daily chart. Instead, I was monitoring the hourly chart. Now, the reason why I was monitoring the hourly chart is because I prefer my trades to be closed within one day or maybe a couple of days. I don't want, if it's on a daily chart, you have to hang on for a little while, like at least a week, maybe more, because you have to think about how many candles is going to be a wave completion and therefore how many days that is. Now, if you think it's going to be like 12 candles for a wave completion, then that's going to be 12 days. And that doesn't mean less than 2 weeks, because we're talking about 5 days in a week. So that's over 2 weeks that you'd have to hang on just for a wave completion if it's a direct move, which is not what I like to do at the moment. So I was monitoring the hourly chart. Now, with the way I was approaching on the hourly chart, I was actually hoping that I can enter based on the hourly chart. So I like limit the amount that I have at risk there, but at the same time, hoping that it will cascade into the higher time frames and become a bigger trade. However, there were a couple of things that were an issue for that. So I will first talk you through my entry, and then I'm going to get the economic calendar open and we can go through that. All right, so I had to stop for a second there so I can get the economic calendar open. So looking at this hourly chart, we can see two things that we had going on. So my entry was actually in this area around here. I'll talk you through that in a second. But first of all, we can see that we've got this trend line here. And there was some interactions that made me certain that this was the correct positioning of it. So we can delete those. We have our first anchor point here, second anchor point. This kind of helps me to confirm it was the correct positioning, but despite that, it's not a proper wave off there, so this is an unconfirmed trend line at this point. So we have one unconfirmed trend line. At the same time, we have our Fibonacci range here, A, B, C point confirmed with a type 2 and a type 1 and another type 1, and not that one because it was in the past, at the 38.2. So this is confirmed, and you can see that at the 127.2, we have some interactions around here. Now, when I approached the markets, it was something like 5 o'clock in the morning, which I believe was about here, the sort of time. The server time on this is wrong. So anyway, it was around this sort of time. I believe it was like one of these pin bars or something. Anyway, didn't actually open based on the hourly, because with our extension levels, you never want to trade the retest particularly. Like, this is the first interaction of that 127.2. Okay, that's type 1, price moves up. These ones down here are a retest of it. If it happens directly after that candle, then you may want to trade it. But if it's like this, it's had this reaction, for us that means that setup completion is likely to have happened, and instead we will be waiting for the 161.8. So instead I'm like, okay, on the daily chart we have a double confirmation. On the hourly chart we have unconfirmed single confirmation and a Fibonacci extension level which it's reacting to but is no longer in play for us. So okay, I'm going to find an entry on a lower time frame which is going to get me into this trade. So over here then we had a very similar situation. So we have an unconfirmed trend line starting from this point here, there. Again, we have like some failure there, but it's this point here that I'm interested in. Now, at the same time, we also have the Fibonacci range going on. This sort of big move down here has squashed up this part of the chart, but we have A, B, C point confirmed there at the 50% level, and that gives us then this 161.8. Now, you will see that basically it was this candle here. The close of this candle was my entry, so here. And I posted that on the Instagram story. Maybe we could put it on screen so that you can actually see that.
Morning guys, up bright and early with the entry I was waiting for on Euro Aussie dollar. It's now 26 in the morning UK time. This entry came a little while ago, but here's the daily chart. You can see it's pushed through the trend line, but it was a type 1 on the 161.8 yesterday and a type 2 on that trend line. So as it pushed through this morning, we were looking for entries. On the hourly chart, we have this unconfirmed trend line plus a 161.8 from this range over here. Confirmed C point there at the 38.2. And we had the type 2, maybe with a bit of tolerance there. And at the same time, on the 15-minute chart, more recently, this is where the entry came from.
But you might be looking at this interaction here, this one, and thinking, well, that already interacted with the 161.8. On the hourly chart, we weren't going to enter because of that. Why can we enter here? It's because we've definitely not had setup completion yet. It's continued to push down, and the fact that we have a relatively big wick on that candle is usually a sign that actually we wouldn't enter on that because the price can still be attracted back down to here. We did have a type 2 close on the 127.2, but we would expect there's a good chance it gets attracted back down to that level. And so when we have that type 1, if I was relying just on this setup on its own, this 15-minute chart, you can see that we have as one of our double confirmation an unconfirmed trend line, and the other one we have a 161.8, which had a bad reaction the first time. So it's not the strongest setup, but we have now on a 15-minute arguably a double confirmation. On the 1 hour we have a single confirmation unconfirmed, but could be anything up to a double confirmation really, depending on how you want to look at that situation. So let's say a single confirmation anyway. And on the daily chart we have a double confirmation, and on the weekly chart we had a very good situation in general, so that's good for market selection. Overall, I was willing to enter here. Usually we always want to make sure that our trade management is going to be based on the time frame that we're entering on. So in most cases that's what you'd do, and in which case I'd be 100% trading the 15-minute chart here. However, I was actually wanting to trade the hourly, but because of the uncertain setup, I needed to find the certainty by going down in time frame and understanding what the real situation is. So my trade management was going to be based on the hourly chart, and my stop loss was going to be based on setup rather than structure. So what ended up happening, let's just zoom in a bit more. So my entry point is over here, okay, at the start of this bullish candle. My stop loss was a bit down here. Now, the stop loss here, it doesn't need to be that big. It can be quite tight because it's only relatively small movements in terms of pips. So you'll see that the stop loss to the wick there is about 9 pips. But in general, I don't like to have a stop loss that's anything less than 10 pips. Plus, obviously, you've got to factor in the spread. And because we're based on the hourly chart, I ended up having it a bit further, and it was 12 pips for my stop loss. So it was literally around here. Now, you can see, let's say it's about here, you can see that the price initially moved up, and then it kind of struggled around here, pushed back down. And at this point, we did what I call, or my team calls, the stop loss dance, where it's right by your stop loss. You can get triggered at any moment, and then it pushes up afterwards, or sometimes it does trigger. We survived the stop loss dance here, and then it starts to push through some of the stronger levels that we had going on, which you can see a lot better on the hourly chart. So I'm going to switch back to the hourly chart for now. So here it starts to push up, push through these areas here that it was struggling with before. And then at this point here, this bullish candle, I exited. And you might be thinking, why did you exit? That's a bit convenient because it's just before that bearish move. It's because it was the ECB interest rate announcement. And of course, you don't want to take that risk. We spoke about this in the video about trading around financial news. In fact, I mentioned the ECB press conference in that video. And with your intraday trading, remember I said nearer to the start that with this trade, I didn't want to be holding it for days and weeks. I hopefully wanted to be out of it within that day or maybe the next one. So if you're trading intraday, and with the Duomo method, we want to be trading steady state markets, not herd activity. So the ECB is going to cause a lot of herd activity. It's going to disrupt your trade. Even if you're on the right side of the news or the right side of how the market interprets the news, you can still have your stop loss triggered. So it's better to exit and not take on that risk. Okay, the camera cut out as I was explaining that. So basically, on top of it being just a regular ECB interest rate decision and announcement and so on, it was also one where the market was pretty much certain that there was going to be a cut in rates. I think the majority in terms of the consensus was expecting rate cuts. It was just about whether it was going to be 10 basis points or 20. So it ended up being 10 basis points, but that was important because we needed to know how much is likely to have been priced in. Now, even if it was in line with expectations with the 10 basis points, this is obviously a negative thing for the euro, at least in principle, the interest rate cut. which means that, as you would expect, the euro is going to fall, and that's what happened. So even if it's in line with expectations, you could still have a severe reaction because it's still an important thing that's happened. It's not about whether it's a surprise to the market or not sometimes. It's just about that people have positions leading up to that, and now the news is out, then the positions can readjust. So in this case, we wanted to be out of that trade. Now, one of the questions that arose on the forum was about a news release that came out at 7 o'clock in the morning UK time. So I opened the trade at 5:45 AM UK time, 5:45 in the morning. And you can see here, an hour and 15 minutes later at 7 AM, we have CPI data from Germany. Now, you may remember from our video on how we trade around financial news that if it's a high volatility release like this one and it's relevant to the currency that you're trading, then you'll probably want to either set a stop loss, be out of the trade, make sure you've got enough of a profit buffer. Now, if we look at the charts quickly, we can see that around that time, I didn't have any profit buffer at all, very slightly. So people on our forum were asking why I stayed in the trade there. So again, I want to refer you back to that video on how to trade financial news or how to trade around it, that I said that some news releases are going to be more or less important depending on the context of that specific point in time. I spoke about how with unemployment data, it's going to be relatively more or less important than inflation based on how the central bank's looking at that information at that point in time. So of course, Germany, being the largest economy in Europe and one of the biggest economies in the world, is going to disrupt the euro in most cases. However, with the euro, we know that later on that day, we have the ECB announcement and a likely change in interest rates, where the market is certain it's going to happen, like the majority of people in the consensus think it's going to happen, it's likely to be priced in. And therefore, although this may disrupt the markets a bit, it's kind of being overshadowed by that ECB rate decision. So unless this is going to be a really big surprise, I wouldn't expect it's going to be affecting the markets that much. And also, like, we can see that the movement down, look, the movement down, it's been very sort of structured. It's almost like the market's ready for a bit of a bounce. So even if it was something that was going to be negative for the euro, it's likely to only have a small fluctuation, probably not hit stop loss at that point. And if it does hit stop loss, that's fine. I'm willing to take that risk and then find a re-entry. You know, a lot of times with these high volatility releases, it's not so much about how it may hit our stop loss if the news release causes the price to go against us. It's more about whether it's going to cause slippage. So if there's not much risk of slippage happening, and if it's not going to disrupt the reasons for you opening the trade in the first place, then you can stay in the trade. And so for me, in this case, it wasn't going to disrupt the reasons for me opening the trade in the first place. Very low chance of having any slippage. If it did go against me, I was able to stay in the trade. Now, obviously the interest rate decision, that's a different story altogether. And so I exited, and that gave me about 30 pips profit. So you can see from the entry around here up to about there, it's around 30 pips profit that I had from that. Now you can see that obviously we had the interest rate cut, which was going to be negative for the euro, but really that's just the knee-jerk reaction in the markets. It's not actually necessarily that negative because it wasn't the 20 basis points, so it wasn't the bad end or the good end, depending on how you want to look at it. It also means that the ECB are still willing to do whatever it takes to support the euro, and it could be good for the banking system. So although there's a knee-jerk reaction, it then started to move up and quite strongly. Now, at the same time, there are other news, more economic things that are affecting this pair. But anyway, you can see that exactly where it starts to move from is on that 161.8. So you see, when we have a confirmed Fibonacci range, it won't just be the level that we trade off. Like the 127.2, if it doesn't re-enter the range, which it didn't, you know, it reached TMP, but it didn't close through it, re-entering the range up here. So it's still in play, as I had mentioned earlier. And therefore this 161.8 is still in play, and we know that these levels have been causing reactions from both sides. So when we got that type 2 close, we can see that you would normally expect the price to move up from there. However, our negative filter would keep us out of this trade because our triad of price action trend, momentum, volume would all be going through the roof at this point.
The thing that I love though is that even with all of that herd activity, the same range that we used on the hourly that we had the 127 from earlier, the 161.8, it closed there as a type 2. Now, obviously we would not be entering here because of the Triad. The price action would keep us out of it, but it's always nice to see how those levels are still relevant despite the herd activity. It's just that we prefer to stay safe.
Trend is obviously very bearish at this point in time, okay? The momentum, look at the size of this candle compared to the others. It's obviously momentum from the ECB announcement, so it's huge amounts of momentum and volume. You can see it down there. Now, when it comes to Forex, the volume is not reliable in absolute numbers, but you can look at it relative to the sort of bars close to it as a sort of guide. That's why we use the Triad of price action together as the three. We don't use any of them individually on their own because it's important that you put them all into perspective as a whole. So we wouldn't have entered here, but I did put on the Instagram story that it was interesting that it closed there as a type 2. And this one was obviously momentum running out. It could have been a bit more like viable for a trade entry, except volume was still extremely high. And the size of that wick, we just wouldn't want to trade that situation. So you can see the price starts to move up strongly from there. So you can see already now, in the recent lessons that we've had, we've covered how to trade financial news. We've had a couple of situations here that show that in a bit more detail. We can see the negative filters in play with this. And we've seen how you choose where you're going to make your decisions based on the TMP and that kind of thing. Now, we can see that that TMP decision would have been really important because people that base their stop loss on setup around here would have been triggered. They'd be out of the trade. People that base their stop loss on structure and had it down here, this wouldn't have triggered it. This would have been in line with their soft stop loss, but since their hard stop loss would likely be at least below those wicks and this didn't break through there, they would have still been in the trade. So what happened next? Well, as you'd expect from a double confirmation on a daily chart from a trend line and 161.8 that is so, well, mainly the trend line that's so strong and dependable, the double confirmation led to a bullish close. After that, you can see we had a bit of a bearish move and it closed through the trend line again. Now at this point, I was not in any trade. I'd taken my 30 pips, I'd moved on. If I had been in this trade from here, I would have had a stop loss trigger because I probably would have based it on setup rather than being down to the structure here. But I do know some people would have still been in it. So let's go through this anyway. And this is what I was saying to you before. It's not the best trade in the world because my 30 pips that I picked up are not amazing. It's a decent intraday trade, but not an amazing one. And with this daily chart, you could have either had your stop loss triggered or just about stayed in the trade. But there are just so many lessons in this situation. I love it. So the price moves up, comes back down and closes through. Now, do you remember earlier I was saying about your stop loss is probably going to be based on this 161.8. So even though it's closed through this trend line, it hasn't closed through the stop loss. And more importantly, it hasn't closed through or even tested, hasn't broken through the wick of the setup candle, which is very important because it's not a setup break unless you break through the wick of the setup candle and close through it. So anyone in this trade would still be staying in here. Now, if you came to this situation afterwards and you weren't in a trade, could you open a trade at the close of this bearish candle? It's a type 1 at the 161.8. Would we be able to go for it? The first thing, some people will say no, because there's a conflict between our significant levels since there's a trend line just above and it's a solid one, it's a baseline trend line. So we may be testing that from the other side, in which case we'd be heading that way. So that's the first thing. But if that trend line wasn't there, would we be able to trade based on this? Now, forgetting that it's just a single confirmation. Well, again, no, because we have, first of all, the fact that this 161.8 has already been in play, already had setup completion before it's approached it again. So this is no longer in play for us. The second thing is that potentially, with the amount of momentum it's had, we're looking at trend, momentum, and there's not been any higher highs or anything like that yet. So even though volume, we can't really tell from here, it's quite small, and there's no way to test it relative on this sort of scale here, the Triad of price action would be a no. So our negative filter is telling us again, it's not the right time to enter. And yet you can see what ended up happening. So it's basically, if you had your entry on this daily chart here and had your stop loss based on structure, which would have been just under a 2-to-1, you would have today just about reached your TMP. Maybe it's just slightly off, but there's a good chance it's going to push up and reach that at some point anyway. So that's one way you could have traded it. The other way is to take my trade entry, which led to a 30 pip profit if you closed before the ECB announcement. And just in general, this whole situation has been really interesting. There's so many different factors at play here. And you see how we still get that reaction at the 161.8 here. That's because, like I was saying before, when it's a confirmed range and we see reactions at the significant levels, then that Fibonacci range can still be relevant for us. It can become what we refer to as a Duomo Fibonacci grid, which when you leave it on the chart, because every time it's interacting with the significant levels, it's still relevant. And that's the reason I left this 1 hour one on the chart, besides the fact that I'm using it to explain to you now how I approach the market. But I also wanted to see, as we get to some of these key levels, how the price reacted. Now, with the Duomo grid, it's not something we use as part of our double confirmation, but what it can do is help us to have even more conviction in our entry if it's combined with a double confirmation, so we can have a higher position size. Okay, so if you're looking at a double confirmation, or let's say one part of your double confirmation is unconfirmed, but you also have this in there, it may just about tip it into being confirmed, being a full trade rather than a probe trade, or at least a bigger full trade, making the probe trade even bigger then. So guys, I think that's pretty much all for now. There were quite a few things here. If you haven't been learning the Duomo method, then you'll probably be listening to this and be like, whoa, that was a lot to take in. But trust me, it's much more straightforward than you think once you start learning it. Once you start realizing that things are interdependent and interconnected, and when you learn how one significant level works, it's going to help you with the rest of them. And when you understand it's not about any individual factor, but how we approach the situation as a whole. Now, if you've been following our market selection service, then you would have seen that we can easily pick up pinpoint reversals, and the levels we use, as long as you approach them the right way and understand how to confirm them correctly, do hold up just like it did here. And if you're following us on Instagram, you're going to see when I post these things live sometimes in our story, and that way you can see these pinpoint reversals happen very often. So guys, if you want to learn more about this method, then of course, check out the market selection service. It's free, and then you can see what markets I'm looking at each of the days that I'm trading. And also in the description box is a link to join our introduction course, Introduction to Trading the Duomo Method. It's 10 easy to follow lessons. There are quizzes in there, activities, and it's just going to help you understand like the principles of what we're doing here. So guys, appreciate you watching. If you have any comments, leave them below. If you like this video, let me know in the comments section that you want to see more spotlight sessions, and don't forget to hit that thumbs up or the subscribe button. Take care. I'll see you in the next one.